The Federal Reserve just admitted it can't cut rates without crashing the economy. Back in 2022, everyone expected the Fed would start cutting rates by now. Inflation was supposedly cooling, unemployment was stable, and the playbook said lower rates should follow. But then something shifted. The Fed looked at the data and realized that cutting rates even slightly could unleash a new wave of spending and reignite inflation. Yet keeping rates frozen at 3.5 to 3.75% means the government keeps paying astronomical interest on its debt, and consumers keep struggling with credit card payments and mortgages. The Fed is trapped. Cut rates and risk inflation spiraling. Hold steady and watch the debt crisis deepen. There's no winning move anymore. Here's the mortgage trap that's quietly destroying the housing market. Imagine you bought a home in 2019 and locked in a 2.5% mortgage. Your monthly payment on a $300,000 home was around $1,200. Today, that same home costs $450,000 because prices doubled while rates were low. A new buyer faces a 3.5% mortgage on $450,000. That's roughly $2,000 a month. They're paying 67% more per month for the exact same house. But here's where the trap tightens. Those original homeowners with 2.5% rates are now completely locked in. Selling means losing that rate forever and jumping into the 3.5 to 3.75% market. So they stay put, refusing to move up or downsize. This creates what economists call rate lock paralysis. The housing supply shrinks because people won't sell, prices stay elevated because inventory is scarce, and new buyers, mostly younger Americans, are priced out entirely. The Fed's rate freeze at 3.5% isn't actually freezing anything. It's calcifying the entire housing market into two classes, those who got lucky 5 years ago and those who will never afford a home. This is how policy decisions create permanent economic inequality within a single generation. For the first time in 20 years, your savings account is actually making you money. Not nominal money, real money, after inflation. A 5-year CD right now locks in around 4.8% annually, while inflation is running at 3.4%. That's a 1.4% real return. 20 years ago, savers couldn't touch that. Banks were offering 0.01%, while prices climbed 3% a year. You were losing money just by saving. But here's the trap. This window is closing. The moment the Federal Reserve cuts rates, and economists widely expect cuts sometime in 2024, savings rates will follow. CDs will drop to 3%, then 2%, then back to the financial wasteland of 0.5%. Savers who waited too long will watch their gains evaporate overnight. Consider a concrete example. A person who puts $100,000 into a 4.8% CD today locks in roughly $4,800 in annual gains. Wait 6 months for rates to drop to 3.5%, and that same $100,000 now earns only $3,500 yearly. That's $1,300 lost, permanently, because you hesitated. The takeaway is brutal. Savers have a closing window to capture the best returns in 2 decades. After that, the Fed's next cuts send everyone back into the financial desert. Here's the number that should terrify you. The U.S. government is now spending more money on interest payments alone than it spends on national defense. Last year, interest on the national debt hit $659 billion. That's more than the entire Pentagon budget. And it's growing faster than any other line item in the federal budget. The Fed's decision to hold rates steady at 3.5 to 3.75% isn't just about inflation or employment anymore. It's about preventing a debt spiral that could bankrupt the government itself. When rates were near zero, the government could borrow trillions at almost no cost. Now, every new dollar borrowed costs significantly more in interest. The math is brutal. If rates stay frozen, the interest payments plateau. If the Fed cuts rates to rescue the economy, the government gets temporary relief, but inflation might roar back, forcing rates higher later. If the Fed keeps rates elevated to fight inflation, interest payments explode and the government can't afford basic services. The Fed isn't pausing to protect you. It's pausing because moving in either direction triggers a catastrophe. The debt bomb is ticking, and the Fed just hit snooze. So here's what we've learned. The Fed is trapped. They can't cut rates without letting inflation spiral again, but they can't keep them frozen without crushing borrowers under mounting debt. They're not solving the economy anymore. They're just choosing which group gets hurt first. The wealthy who own assets? They're protected. The working families taking on new mortgages? They're exposed. This is the real story behind the pause. Subscribe now to see which households get hit hardest next.